Hello, welcome from Trend Signal for our review of the data and events the week beginning the 5th of December. So, jobs report came and went last week. No shocks or surprises really. I think we're pretty much on track for a US rate hike on the 14th of December. This is the Chicago Mercantile Exchange countdown to FOMC. So this is basically showing, I'll just put it on December actually, it's a 92.7% probability of a rate hike, which is pretty much certain in most people's language. What is interesting, the reason why I'm looking at this site is already, and this is gradually happening with as Trump assembles his team as ahead of his inauguration on the 20th of January, already expectations have jumped forward now for the next rate hike. So you can see here for June next year, there's a 40.5% chance of a 75 to 100 basis point range, i.e. a 25 basis point jump, and a 9.6, call it 10% chance of 2 rate hikes by then. So in total, the two of them, it certainly suggests that the majority now believe that there is a possibility of a rate hike by June next year. And I think this is going to be reflected more in the US dollar as it tracks higher, possibly. Certainly not this morning. There's been a bit of a relief rally across the board following the Italian referendum. So let's just have a look at really what happened there. The referendum result, in case you are unaware, a no vote to changes in the Constitution, keeping the Constitution the way it has been since 1948. Not really a surprise at all, actually. Even the inaccurate and usually unreliable Italian polls, all polls seem to be unreliable really, they managed to get this one right. The scale of the victory, I think, was the surprise, a high turnout which favoured the no vote. So the no vote winning by 59% to 41%, which is pretty solidly no, quite frankly. The question is, why is the euro rallying if this is bad news for the third largest economy in the Eurozone? Well, I think mainly because there is no immediate impact. On the opening on Monday morning, the Italian banking sector reflected the news down to 3.5%, but I thought that was pretty modest considering the doom mongers last week. The banks of greatest concern, and there's a list of sort of 6 or 7 of them really, registered losses of around 5.5%, the likes of UniCredit, Monte dei Paschi, Banca Popolare, Banca Milano, but they've all rallied at time of speaking, now at 9:30 on Monday morning. In fact, there's a bit of a relief rally across the board. Equities sharply higher, rebounding from their lows. The DAX, MIB, FTSE all sharply higher. Bond markets rallying as well. And not just that, the euro. Have a quick look at the euro. This is the euro rallying from a low of 105.06, which was the lowest level it's been. This is against the dollar, obviously. The lowest level it's been since March 2015. That would have been a fall of about 1.5%. That was then at 4 o'clock, 5 o'clock, half past 4 in the morning. But come 9:30, 10 o'clock as I'm speaking now, that has certainly been turned on its head. And I think the reason why is that there is no immediate impact, really. This was predicted, and I think the markets have a great way of really absorbing, preparing for the bad news ahead of it. And let's face it, there were no immediate impacts, certainly in the banking sector, which is something that we all worried about. The next election in Italy is not scheduled till 2018, and I think the idea is these parties put together a grand coalition. It's not good news for Italy in the long run. They need to take decisive action, and in fact, Matteo Renzi made a political error of judgment tying in his fortunes with this referendum. But I suspect if he had not said he would resign, I think it would have stood more chance of getting through, ironically. So the populist parties have momentum now, and the likes of Five Star could well be in contention to win the next election whenever that happens, and it's possible that it could happen before 2018, depending on how events turn out. But not good news for Italy, not good news for an economy that struggled for a long time now. and the chance of getting any meaningful decisions taken with the Grand Coalition is fairly minimal. Okay, so that's the Italian referendum really out the way for now. Let's look at the what's expected from the markets this week. We're starting with today with the services sector. We've had the manufacturing sector last week. The services sector, certainly in the UK, we're looking for slightly weaker number from the one in November of 54.5. In the US, referred to as the ISM non-manufacturing, but that really means service sector, obviously. We're looking for a stronger number, 54.8 last month, 55.3, all adding to the unanimous belief now that we'll get a rate hike in December, and as markets continue to speculate on when the next hike after that will happen. We have two interest rates decisions this week that will result in no change. That is the Australian Reserve Bank of Australia overnight, Monday night, Tuesday morning, maintaining a rate of 1.5%, so expectations for no change there. The other one is the Bank of Canada on Wednesday afternoon. We're not expecting any change there, maintaining a rate of 0.5%. The main event of the week, undoubtedly, is the European Central Bank meeting, the final meeting of 2016. Speculation as to what they're going to do in terms of extending quantitative easing. Mario Draghi is expected to announce an extension of the bank's 80 billion a month bond buying program, or quantitative easing. Expectations are that it will be extended. If it's not extended, it could underpin, I should say, the euro, but we're expecting an extension of that. Paradoxically, there may also be talk of tapering, and the central bank has got to address how it stops it at some stage as well. I can't believe they'll do it all in the same meeting, actually. It would send a very mixed message, but certainly we're expecting that. No change in obviously in any interest rates, but that is what is expected out of the European Central Bank. We get the announcement of rates at 12:45, but of course it's the press conference at 1:30, which is the main interest to all of us. Before we get that on Wednesday, it's something that's obviously taken a lot more relevance these days. Now we've got OPEC out the way, the oil market rallying substantially last week following agreement by OPEC to cut production by 1.2 million barrels per day. Oil, UK oil, or Brent as we refer to it, at $7.50 it rallied last week. That's nearly 16%. US oil, or WTI, West Texas Intermediate, that rallied $5.15, so lagging Brent, still up 11%. The story of OPEC, shale oil, etc., will continue, and so the inventories will have an impact on those markets. Obviously, the question is, how quickly will shale oil react to the increase in price that could offset the cut in production by OPEC members? Time will tell. Obviously, this doesn't come into effect until January next year. That's pretty much it for this week, actually. Thanks very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.